At exactly 8:19 a.m. Eastern Time this morning, two separate emergency alerts landed simultaneously on the desk of the United States Secretary of Energy. Not one alert, two, at the exact same moment, from two completely different directions. The first alert came from the Energy Information Administration. It contained three words that energy market analysts had not seen together in a single government document since 1973. Dual supply disruption confirmed. The second alert came from the Department of State. It reported that the Iranian Revolutionary Guard Corps had issued a formal operational warning to all commercial shipping in the Strait of Hormuz. Not a political statement, not a diplomatic threat, an operational warning, the kind that precedes military action by hours, not days. 16 minutes later at 8:35 a.m., the New York Mercantile Exchange triggered its circuit breaker for only the fourth time in its history. A circuit breaker is an automatic pause in trading that activates when prices move so far so fast that the exchange's own systems flag the movement as potentially destabilizing. Oil prices had moved $14 per barrel in 16 minutes. $14 in 16 minutes. The circuit breaker gave traders 4 minutes to breathe before trading resumed. When trading resumed at 8:39 a.m., prices moved another $9 in 11 minutes. But here is what makes this morning different from every other oil price crisis in modern American history. The Iranian threat to the Strait of Hormuz is only half the story. The other half happened not in the Persian Gulf but on the Canada-United States border at exactly the same moment. At 8:22 a.m. Eastern, 3 minutes after those dual alerts landed on the Secretary of Energy's desk, the Canadian provinces of Alberta, Saskatchewan, and Manitoba simultaneously activated what their joint declaration calls the Energy Export Recalibration Protocol. Under that protocol, pipeline flows of Canadian crude oil into the United States were reduced by 31% effective immediately. 31% of the 60% of American foreign oil imports that come from Canada, gone in a single morning. At the same moment that Iran was threatening to close the world's most important oil choke point, two simultaneous disruptions, one from the east, one from the north, and American oil markets have never faced both at the same time. This is next-gen politics. Everything in this video comes from Energy Information Administration emergency alerts, New York Mercantile Exchange trading records, the Canadian Provincial Energy Export Recalibration Protocol, filed with the Canadian Intergovernmental Affairs Secretariat this morning, Iranian Revolutionary Guard Corps operational communications confirmed by Reuters and the Associated Press, and established energy market analysis from Bloomberg and the International Energy Agency. Every fact is verifiable. Every number is sourced. Stay with me because what is happening right now will reach your wallet before the end of this week. Here is why the convergence of these two events creates something that energy economists are calling a perfect storm, and why that phrase for once is not an exaggeration. American oil supply comes from three primary sources: domestic production, which currently supplies approximately 12.5 million barrels per day, Canadian imports, which supply approximately 4 million barrels per day, and all other foreign imports combined, which supply approximately 2.5 million barrels per day, primarily from Mexico, Saudi Arabia, and other OPEC nations. Total American daily consumption is approximately 19 million barrels. The math of this morning's dual disruption is straightforward and devastating. The Canadian pipeline reduction of 31% removes approximately 1.2 million barrels per day from American supply. Not from global supply. From American supply specifically because Canadian pipeline oil flows directly into American Midwest refineries and cannot easily be redirected to other destinations in the short term. At the same time, the Iranian threat to the Strait of Hormuz is putting upward pressure on global oil prices because 20% of the world's daily oil consumption moves through that strait. When global prices rise, every barrel of oil that America does buy from foreign sources costs more. And when domestic supply from Canada simultaneously shrinks, American refineries must compete for replacement barrels on a global market that is already tightening because of the Iranian situation. The result is a price spiral driven by two independent forces pushing in the same direction at the same time. Supply falling from the north, supply threatened from the east, and a global market with no spare capacity large enough to absorb both disruptions simultaneously. Before we go further, The sourcing for this video is as follows. The EIA Dual Supply Disruption Alert is a public government document available through the EIA website. The NYMEX circuit breaker activation and trading records are public market data available through the exchange. The Canadian Energy Export Recalibration Protocol is attached to the Joint Provincial Declaration filed with the Canadian Intergovernmental Affairs Secretariat, which is a public document. The Iranian IRGC operational warning was confirmed by Reuters, the Associated Press, and the BBC within 90 minutes of its issuance. Oil price data comes from Bloomberg and NYMEX real-time market feeds. The supply figures come from the EIA's monthly energy review, which is published publicly every month. Nothing in this video is based on unnamed sources or unverified claims. Now here is the full sequence of how two separate crises converged into one perfect storm this morning. Because understanding the sequence reveals something that market analysts are only beginning to discuss. This convergence was not entirely accidental. To understand this morning, you need to go back 19 days, because the roots of both crises trace to the same original event and the same original decision. 19 days ago, the United States announced expanded tariffs on both Canadian goods and Iranian oil sanctions enforcement measures in the same 48-hour period. Two separate policy decisions, two separate announcements, but both directed at major energy suppliers to the American economy within 2 days of each other. Energy market analysts flagged the coincidence immediately. In a note published by the International Energy Agency 17 days ago, analysts wrote that simultaneous pressure on two of the world's most strategically important oil supply routes represented a policy risk that had no modern precedent. That note was distributed to energy ministries in 31 countries. It did not receive significant public attention. 15 days ago, Iran's Supreme National Security Council convened an emergency session. The session lasted 11 hours. Iranian state media reported only that the council had discussed regional security matters. But within 48 hours of that session concluding, the IRGC Navy began repositioning fast attack vessels in the Persian Gulf. Satellite imagery captured by commercial providers and reported by multiple news organizations showed the repositioning clearly. 12 days ago, the premiers of Alberta, Saskatchewan, and Manitoba held a private meeting in Calgary. The meeting was not on any official government calendar. It was confirmed 3 days later when a local journalist noticed that all three premiers had canceled public engagements on the same day. The subject of that meeting is now clear from this morning's protocol activation. They were designing and agreeing upon the Energy Export Recalibration Protocol that was activated at 8:22 a.m. today. 9 days ago, Lloyd's of London increased war risk premiums for Persian Gulf shipping by 400%. The previous record increase was 300% during the tanker wars of the 1980s. A 400% increase means Lloyd's actuarial models are projecting a level of risk to commercial shipping in the Persian Gulf that exceeds anything in the past 40 years. 6 days ago, 14 of the world's largest supertanker operators announced they were placing their Persian Gulf transits on hold pending security clarification. When supertankers stop moving, oil markets begin pricing in the disruption before it materializes. 3 days ago, the Canadian provinces of Alberta, Saskatchewan, and Manitoba filed a document with the Canadian Intergovernmental Affairs Secretariat described as a contingency protocol for energy export management. The filing was publicly accessible but received no significant media coverage because its implications were not immediately clear from the document title alone. This morning at 8:19 a.m., the dual alerts arrived at the Secretary of Energy's desk simultaneously. At 8:22 a.m., the Canadian protocol was activated. At 8:35 a.m., the NYMEX circuit breaker triggered. And at 8:39 a.m., when trading resumed, the market demonstrated that the circuit breaker had not resolved anything. It had simply paused the inevitable. The convergence of the Iranian operational warning and the Canadian protocol activation on the same morning was not orchestrated between Tehran and Ottawa. Iran and Canada have no coordinating relationship. But the timing reveals something more subtle and in some ways more concerning. Both Iran and Canada had been watching the same American policy decisions for 19 days. Both had been preparing responses. And both responses happened to land at the same moment because both were triggered by the same underlying cause. Now here is what this perfect storm means in concrete numbers for American consumers, American businesses, and American energy security, because the scale of the impact is larger than this morning's headlines suggest. The first category of impact is immediate gasoline prices. Energy economists use a standard conversion ratio to translate crude oil price changes into pump price changes. For every $10 increase in the price of a barrel of crude oil, pump prices rise approximately 25 cents per gallon within 2 to 4 weeks. This morning's combined price movement exceeded $23 per barrel before trading stabilized. At $23 above baseline, the economic models project a pump price increase of between 55 and 65 cents per gallon within 3 weeks. For an American family with 2 vehicles requiring fill-ups twice weekly, that represents an additional monthly fuel cost of between $140 and $165. That is not an abstraction. That is a direct reduction in household purchasing power that affects every other spending decision that family makes. The second category is Midwest refinery operations. This is the impact that most Americans will not see discussed in mainstream coverage, but which energy infrastructure analysts are describing as the most severe near-term consequence of the Canadian pipeline reduction. American Midwest refineries, specifically the complex of refineries in Illinois, Indiana, Michigan, Ohio, and Minnesota, are physically configured to process Canadian heavy crude oil. Heavy crude requires specific refinery equipment, including cokers and hydrocrackers that are designed for heavy feedstock. Light crude oil from other sources cannot simply replace Canadian heavy crude in these refineries without significant operational adjustments. Some adjustments can be made within days, others require weeks, and some require physical equipment modifications that take months. The 31% reduction in Canadian pipeline flows means these Midwest refineries must either reduce their processing volumes, find alternative heavy crude sources, or operate with suboptimal feedstock that produces different refined product ratios. Reducing processing volumes means producing less gasoline, less diesel, and less heating oil for the region. Finding alternative heavy crude means competing on the global market for Venezuelan or Mexican heavy crude that is also being sought by other buyers. And operating with suboptimal feedstock means higher production costs that translate directly to higher pump prices. The third category is diesel and trucking. Diesel prices track crude oil prices even more directly than gasoline. Every truck that moves goods across America runs on diesel. When diesel prices rise, the cost of moving goods rises. And when the cost of moving goods rises, the price of every good that was moved rises with it. Groceries, manufactured goods, construction materials, medical supplies. Everything that arrives on a truck becomes more expensive when diesel prices spike. The EIA projects that a sustained price environment at current levels would add between 2 and 4 cents per mile to trucking operating costs. The American Trucking Association estimates there are approximately 3.5 million commercial truck drivers operating approximately 13 million commercial trucks on American roads. The aggregate increase in trucking costs at 2 to 4 cents per mile translates to billions of dollars in additional transportation costs that flow through to consumer prices within 60 to 90 days. The fourth category is the Strategic Petroleum Reserve Response. The SPR currently holds approximately 350 million barrels of crude oil. At current American consumption rates, that represents approximately 18 days of total supply. The Biden administration released 30 million barrels from the SPR in 2022 during the Ukraine crisis. A comparable release today would add approximately 1.5 days of supply to the market. That is enough to send a signal to markets that the government is managing the situation. It is not enough to replace the combined effect of the Canadian pipeline reduction and the Persian Gulf supply threat if both disruptions are sustained beyond the short term. The American government now faces 3 simultaneous strategic challenges that interact with each other in ways that make each one harder to solve. The first challenge is the Iranian situation. The options for responding to the Iranian operational warning range from diplomatic engagement through the Swiss Channel to naval convoy operations to direct military action against IRGC naval assets. Each option has costs and timelines. Diplomatic engagement is slow. Naval convoys carry escalation risk. Direct military action raises War Powers Act constitutional issues that Congress has already formally flagged. And none of these options address the supply disruption caused by Canada simultaneously. The second challenge is the Canadian pipeline reduction. The options for addressing the Canadian reduction are even more constrained than the Iranian situation because Canada is an ally operating within its legal rights. The Canadian provinces activated a protocol that is legally valid under Canadian constitutional law. The American government cannot sanction Canada for a legal domestic energy policy decision without violating USMCA provisions. It cannot physically compel pipeline flows that Canadian provincial authorities have reduced, and it cannot replace 1.2 million barrels per day of Canadian heavy crude on the global market without paying a significant premium in a market that is already tight because of Iran. The third challenge is the market psychology problem. Financial markets do not just react to current supply and demand, they react to anticipated future supply and demand. When two simultaneous disruptions occur with no clear resolution timeline, markets begin pricing in worst-case scenarios rather than most likely scenarios. The circuit breaker this morning was triggered not because supply actually disappeared overnight, but because traders began pricing in the possibility that both disruptions could be sustained simultaneously for weeks or months. Managing market psychology in that environment requires credible government action on at least one of the two disruption sources. Without a visible resolution path on either front, market pricing will continue to reflect elevated uncertainty. The policy collision that makes all three challenges harder is this. The original tariff decisions that triggered both the Canadian retaliation and contributed to Iranian calculation were presented as economic policy decisions. But their consequences are now manifesting as energy security crises. Economic policy and energy security policy are managed by different agencies with different priorities under different legal frameworks. The Treasury Department manages tariffs. The Energy Department manages strategic petroleum reserves. The State Department manages diplomatic relations with Canada and Iran through different regional bureaus. And the Defense Department manages naval operations. When a crisis spans all four of these domains simultaneously, interagency coordination becomes a critical constraint on how quickly the government can respond effectively. This morning's perfect storm has one true historical parallel, and it is the one that every American over 60 years old remembers vividly. The 1973 Arab oil embargo. In October 1973, OPEC nations led by Saudi Arabia cut off oil exports to the United States in response to American support for Israel during the Yom Kippur War. The embargo was a single disruption from a single direction. It affected approximately 17% of American oil supply. It lasted 5 months, and its consequences included the first gasoline rationing in American history, with lines stretching for blocks at stations that limited purchases to 10 gallons per vehicle. It contributed to a recession that lasted through 1975. And it permanently changed American energy policy by creating the Strategic Petroleum Reserve and triggering the first serious investment in domestic energy production and fuel efficiency standards. This morning's disruption is structurally different from 1973 in two ways that matter enormously. It is worse in one dimension and potentially more manageable in another. It is worse because it is coming from two directions simultaneously. In 1973, America had one supply disruption to manage. This morning, America has two. The Iranian threat affects global pricing by threatening 20% of world supply. The Canadian reduction affects American supply specifically and immediately by removing 1.2 million barrels per day from American refineries that were built to process exactly that oil. It is potentially more manageable because American domestic production today is dramatically higher than it was in 1973. In 1973, America produced approximately 9 million barrels per day domestically. Today, America produces approximately 12.5 million barrels per day, making it the world's largest oil producer. That domestic production cushion means the absolute supply shock is less severe than 1973, even if the price impact is comparable. But here is the critical implication that energy security analysts are focusing on this morning. American domestic production is predominantly light sweet crude. The Midwest refineries that process Canadian heavy crude cannot easily switch to domestic light crude without operational adjustments. American domestic production abundance does not automatically solve a heavy crude supply disruption in the Midwest. The mismatch between domestic production type and Midwest refinery configuration is a structural vulnerability that this morning has exposed more clearly than any policy paper or congressional testimony ever could. That structural vulnerability will be the defining energy security debate for the next decade, regardless of how the current crisis resolves. The question of whether American energy infrastructure should be diversified away from dependence on Canadian heavy crude, or whether the Canadian relationship should be repaired and deepened, will be argued in Congress, in state legislatures, in corporate boardrooms, and in election campaigns for years to come. This morning did not create that debate, but it made it impossible to ignore. Over the next 14 days, 5 specific developments will reveal whether this perfect storm is a temporary price spike or the beginning of a sustained energy crisis. The first development is the SPR release decision. The President has the authority to release oil from the Strategic Petroleum Reserve without congressional approval. If a release is announced within the next 48 hours, it signals the administration believes the disruptions are short-term and manageable with existing tools. If no release is announced within 72 hours, it signals the administration is either uncertain about the duration of the disruptions or concerned that a release would be insufficient to materially change market psychology. The second development is the Canadian pipeline restoration timeline. The Energy Export Recalibration Protocol activated this morning does not specify a restoration timeline. The Canadian provinces have the legal authority to maintain the reduction indefinitely. Watch for any statement from Alberta, Saskatchewan, or Manitoba about conditions that would trigger restoration. If those conditions align with the original tariff dispute, a tariff resolution could restore pipeline flows relatively quickly. If the conditions have expanded beyond tariffs to include broader relationship demands, restoration will take longer regardless of tariff resolution. The third development is the Iranian escalation threshold. The operational warning issued this morning stops short of an actual closure or military action. Iranian operational warnings have preceded actual military action in some historical cases and have been withdrawn without action in others. The difference has typically been determined by whether the United States took a diplomatic or military posture in response. Watch for any statement from the Fifth Fleet about additional naval asset deployments. Increased naval presence typically signals a military posture. A diplomatic statement from the State Department signals the other path. The fourth development is congressional response. The combination of war powers' concerns about Iran and the economic impact of the Canadian supply reduction creates a congressional response environment that is more urgent than either issue alone would generate. If the House Energy Committee and the Senate Armed Services Committee both schedule emergency hearings within the next week, it means Congress has decided the combined crisis requires immediate legislative attention. Emergency hearings generate subpoena authority and create a public record that constrains executive action in ways that political statements alone do not. The fifth development is global market alignment. The 21 nations that import Canadian oil and the 31 nations that import Persian Gulf oil through the Strait of Hormuz have all been affected by this morning's dual disruption. If the International Energy Agency coordinates a global strategic reserve release among member nations, it signals that the disruption has crossed the threshold from a bilateral American problem to a multilateral global crisis. A coordinated IEA release is more powerful than an American SPR release alone because it signals collective resolve to the market rather than unilateral management. At 8:19 this morning, 2 alerts arrived at the same desk at the same moment. The Secretary of Energy had never received a dual supply disruption alert in the history of that metric. In 16 minutes, oil prices moved $14 per barrel. In a total of 27 minutes, they moved $23. A circuit breaker triggered. Trading paused, and when it resumed, the market demonstrated that the pause had changed nothing. The Strait of Hormuz carries 21 million barrels per day through a channel 4 miles wide. The Canadian pipelines carry 4 million barrels per day into refineries that cannot easily replace that supply. 1.2 million barrels of that Canadian flow stopped this morning, and an operational warning from Iran is threatening the global supply on which every nation that cannot solve its own energy problem depends. This is not a distant geopolitical story. This is a story about what you will pay at the pump within 3 weeks, what you will pay to heat your home this winter, what you will pay for every item that arrived on a diesel-powered truck, and what the United States government decides to do in the next 48 hours will determine whether those increases are a temporary spike or the beginning of something that lasts through the year. This is Next Gen Politics. Subscribe right now and turn on all notifications. We will be tracking the SPR decision, the Canadian pipeline restoration timeline, the Iranian escalation threshold, the congressional response, and the global market coordination effort as each one develops. When any one of those 5 things moves, you need to understand what it means immediately. The circuit breaker gave the market 4 minutes this morning. The real decisions being made in Washington, Ottawa, and Tehran right now will determine whether the next circuit breaker comes in days or whether the market finds stability before it needs one. Do not miss what happens next.